Hello there, and welcome to the Sleepy Wealth Stories. Tonight, we are tracing the long and remarkable history of debt, one of the oldest forces in human civilization, older than money itself, older than empires, older than writing as we know it. We are stepping back through thousands of years to explore how the simple idea of owing something to someone else has shaped wars, built cathedrals, launched revolutions, and quietly governed the daily lives of nearly every person who has ever lived. Long before anyone coined a gold disc or printed a paper note, people were already in debt. The farmer who borrowed seed grain from a neighbor before the planting season, the young couple who accepted a gift of cattle from a bride's family and understood that an obligation had passed between households, the villager who received healing from someone and felt the unspoken pull of a debt that could not be easily named. All of them were participants in a system so old that it may be embedded in the very structure of human society. Debt is not simply a financial arrangement. It is a relationship, a moral weight, a social thread that holds communities together and sometimes tears them apart. What makes the history of debt so astonishing is how consistent its patterns are across cultures and centuries. The same tensions appear again and again between the lender who wants to be repaid and the borrower who cannot pay, between a society that needs credit to grow and a morality that finds the charging of interest suspect, between governments that accumulate debts in times of war and the citizens who must eventually settle them. These tensions were alive in ancient Mesopotamia. They were alive in medieval Florence. They were alive in Washington in 2008. They have never really gone away. Tonight, we will travel through all of it, from the clay tablets of Sumer to the credit card in your wallet, from the temples of Babylon to the bond markets of New York. We will meet the merchants who invented instruments that seem impossibly modern, the philosophers who argued that debt was slavery, the kings who defaulted on what they owed, and the ordinary men and women whose lives were quietly defined by whether they were creditors or debtors on any given day. The story of debt is the story of trust, how human beings have tried across millennia to create reliable ways of extending it and honoring it, and when it fails, surviving what comes next. It is one of the most human stories ever told, and it has been going on far longer than most people realize. If you enjoy these gentle journeys, I invite you to like, subscribe, or share a thought below. It helps others find their way here too, one sleepy soul at a time. But for now, let your shoulders soften and your breathing slow. Let the day loosen its grip and allow your thoughts to drift back through time as we explore the long and remarkable history of debt. Let's begin. Debt is older than money, older than markets, and possibly older than civilization itself. The earliest evidence of systematic debt comes not from coins or markets, but from clay. In ancient Mesopotamia, somewhere around the 4th millennium before the Common Era, temple administrators in the great city-states of Sumer began pressing small stylus marks into wet clay tablets to record the movement of grain, cattle, and labor. These were not religious life, was also the center of economic life, and the two were inseparable. To receive grain from the temple storehouse was to enter into a relationship with something larger than yourself. The debt you carried was not merely a financial obligation. It was a covenant. What the Sumerians understood, and what their tablets preserve with startling clarity, is that a complex society cannot function without credit. The farmer cannot plant without seed. The craftsman cannot build without materials delivered before the work begins. The merchant cannot trade without goods extended on trust. Debt, in this earliest form, was not a sign of failure or weakness. It was the lubricant that kept civilization moving through the seasons, through droughts, through the long wait between planting and harvest. The temple's willingness to lend made it possible for the surrounding community to survive hard years and expand in good ones. The tablets also record something else. The terms. Interest was charged from the very beginning. The standard rate in Sumerian commercial lending was often around 20% on silver loans, 33% on grain. These were not arbitrary numbers. They reflected the real risks of agriculture in a landscape where flood and drought were constant threats. But they also created a problem that would echo through every subsequent civilization. The poor, who needed credit most, also bore the highest risk of being crushed by the interest on what they borrowed. The Code of Hammurabi reveals that debt in ancient Babylon had become powerful enough to require the direct attention of kings. Hammurabi, the Babylonian king who ruled in the 18th century before the Common Era, is most famous for his law code, one of the earliest surviving collections of written law in human history. The code addresses hundreds of situations: property disputes, marriage, theft, injury, and professional conduct. But a striking portion of its provisions concern debt. Hammurabi regulated the interest rate that lenders could charge. He specified what collateral was acceptable. He set limits on how long a family member could be held in debt bondage. The practice of pledging a wife, child, or even oneself as labor collateral for a loan. 3 years of debt service, the code says, is the maximum. After that, the bond is dissolved. The fact that Hammurabi felt compelled to write these rules down suggests how serious the problem had become. Debt bondage, the loss of freedom to a creditor, was widespread enough that it required legal constraint. Merchants and moneylenders had grown powerful enough to threaten the social order, and the king, whose authority rested on the loyalty of his people, needed to protect the farming class from being swallowed entirely by debt. The code is, among other things, a political document, a statement that royal power stands above the power of creditors. Hammurabi also instituted something even more remarkable: periodic debt cancellations. When a new king took the throne, or when a particularly difficult year had broken too many families, an official decree could wipe out certain categories of debt: agricultural loans, primarily, the kind carried by ordinary farmers and tenants. The Sumerian term for this act was anjurar, a return to the original condition, a restoration. The slate was wiped clean. Families returned home. Land that had been forfeited was restored. This was not charity. It was an understanding that when debt accumulated beyond the capacity of a society to repay it, the system itself would collapse, and that occasional, managed forgiveness was less destructive than waiting for that collapse to arrive on its own. Ancient Egypt used debt differently, embedding it in a social fabric where the state itself was the supreme creditor. In Egypt, the pharaoh was not merely a king. He was a god, and everything in the land, the soil, the river, the harvest, the labor of every person alive, belonged to him in principle. This theological arrangement had profound economic consequences. When Egyptian farmers worked the land, they owed a portion of their harvest to the state as tax, and this obligation functioned very much like debt. The grain storehouses that lined the Nile were not simply warehouses. They were instruments of fiscal control, built to accumulate the surplus that would sustain the state through lean years and fund its enormous building projects and military campaigns. What is striking about the Egyptian system is how effectively it used the concept of obligation, not just to collect resources, but to motivate labor on an almost incomprehensible scale. The workers who built the pyramids were not, as legend once suggested, slaves. Many were paid workers, receiving rations of bread and beer measured and distributed with bureaucratic precision. They were, in a sense, creditors of the state. They gave their labor, and the state owed them sustenance. And the state, drawing on millennia of accumulated grain debt from the farming population, had the means to honor that obligation. Egypt's agricultural debt system also served a redistributive function. In years of flood or failure, the state's stored reserves could flow back outward, sustaining communities that would otherwise starve. The debt relationship between the pharaoh and his people was not simply extractive. It was, at its best, a kind of insurance, an arrangement in which the concentrated power of the state provided a buffer against the unpredictable cruelty of nature. Whether it always worked that way is a different question. But the architecture of the system was shaped, at least in part, by the practical need to manage agricultural, routinely ran accounts with London merchants who advanced them goods and credit in exchange for future crops. And those accounts grew over decades into obligations that could never quite be settled. A condition of financial dependence that colored Virginia planter culture with a persistent anxiety about status, honor, and the judgment of distant creditors who seemed always to hold the upper hand. The colonial relationship was, at its structural core, a debt relationship. Colonies were expected to produce commodities, tobacco, sugar, cotton, indigo, that would generate the wealth to repay both private investment and the public costs of maintaining colonial government and defense. And colonies began to feel that these obligations were unjust, that they were being taxed and regulated for the benefit of distant creditors and shareholders. immediately divided its founders. The Continental Congress, lacking the power to levy taxes, financed the Revolutionary War through a combination of loans from France and the Netherlands, bonds sold to American investors, and paper currency, the famous Continentals, issued in such quantity that they rapidly lost most of their value. "Not worth a Continental" became a phrase that captured the collapse of that experiment in wartime finance. By the war's end, the new United States was deeply in debt to foreign creditors, to domestic bondholders, and to the soldiers who had fought for it and had not been fully paid. Alexander Hamilton, as the first Secretary of the Treasury, saw in this crisis an opportunity. His proposal, controversial, bitterly contested, ultimately transformative, was to have the new federal government assume all the debts of the individual states, consolidate them into a single national debt, and fund that debt reliably through new federal tax revenues. Hamilton's argument was not purely economic. He believed that a well-managed national debt would bind the financial interests of wealthy Americans to the success of the federal government, giving creditors a stake in the Union's survival, and thereby creating a class of citizens whose prosperity was tied to the stability of the new republic. Thomas Jefferson and James Madison opposed this vigorously. They saw Hamilton's plan as an enrichment of speculators, many of whom had bought up the depreciated Revolutionary War debts from struggling veterans at a fraction of their face value, and as a dangerous step toward a powerful central government that would subordinate the agrarian South to the financial North. Their objections were overruled, but the tensions they identified did not go away. The divide between creditors and debtors, between financial interests centered in northern cities and agricultural interests spread across a vast and indebted countryside, would run through American politics for the next century and surface in almost every major political crisis the young nation faced. The 19th century turned debt into a mass phenomenon as industrialization created new demands for capital on a scale that individuals and even governments had never before imagined. The great transforming technologies of the 19th century, the steam engine, the railroad, the telegraph, the steel mill, required capital investments so enormous that no single person, family, or even city-state could supply them. A railroad crossing a continent needed not just engineering, but financing, the purchase of land, the hiring of labor, the acquisition of materials across thousands of miles, all paid for years before the first revenue-generating train would run. The railroad companies that shaped the American and British and European landscapes were, in a fundamental sense, debt machines, borrowing from bondholders, issuing shares to stockholders, drawing on lines of credit from banks that were themselves leveraged on their own deposits. The bond market expanded dramatically in this period, becoming an institution of central importance to economic life. The Rothschild family, whose banking operations spanned London, Paris, Frankfurt, Vienna, and Naples, became the intermediaries through which governments and major enterprises connected with the pools of European capital seeking reliable returns. Nathan Rothschild in London, his brother James in Paris, their siblings spread across the continent's financial capitals. Together, they moved money across borders with a speed and sophistication that no governmental institution could match. When Britain needed to fund the Napoleonic Wars, when the Austrian Empire needed capital to suppress revolution, when European states needed to borrow to build railroads or canals or ports, they often came first to the Rothschilds. For ordinary people, the industrial age brought credit in new forms too. The building societies that emerged in Britain from the 1770s onward allowed working-class people to pool small savings and lend to members to purchase homes. In the United States, land speculation drove enormous waves of borrowing, with settlers buying farmland on credit and hoping that rising land values would eventually allow repayment. The booms and busts that swept through the American economy throughout the 19th century were largely debt cycles, periods of expanding credit followed by contraction, panic, and the painful reckoning of accumulated obligations. The railroad boom and bust of the 19th century demonstrated how quickly debt could turn from engine to anchor. In the years following the American Civil War, railroad construction accelerated at a pace that seemed almost visionary. Entrepreneurs and promoters sold bonds and shares to investors across the United States and Europe, promising that the iron network spreading across the continent would generate traffic and tolls sufficient to make every investor rich. The Transcontinental Railroad, completed in 1869, was a marvel of engineering and a symbol of national ambition. It was also, in its financing, a tangle of subsidies, land grants, stock manipulation, and borrowed money that would take decades to fully unravel. Many of the railroad companies that built this network were more skilled at issuing securities than at running efficient operations. They borrowed to pay dividends, issued bonds to retire older bonds, and constructed lines through territories so sparsely populated that they could never generate sufficient revenue to service their debt. When the railroad bubble finally deflated in the panic of 1873, triggered partly by the failure of the banking house of J. Cook, which had overextended itself financing the Northern Pacific Railroad. The consequences spread through the entire economy. Banks that had lent to railroads froze. Businesses that depended on bank credit contracted. Workers lost jobs. Farmers who had borrowed to buy land found credit vanishing precisely when they needed it most. The Panic of 1873 inaugurated what historians have called the Long Depression, a period of falling prices, sluggish growth, and agricultural distress that lasted, with some interruption, until the mid-1890s. It was, at its core, a debt deflation, an economy in which the accumulated weight of borrowed money pressed down on prices and activity making it harder for debtors to generate the income needed to repay, which forced more contraction, which made repayment harder still. The economist Irving Fisher would later identify this dynamic as a central mechanism of economic crisis. But the farmers and workers who lived through the Long Depression in the 1870s and 1880s understood it in simpler terms. They had borrowed when credit was cheap and times were promising, and the world had changed around them before they could repay. The First World War shattered the financial architecture of the 19th century and left behind a legacy of debt that would poison global politics for a generation. In the summer of 1914, the great powers of Europe went to war expecting a swift, decisive conflict. What they got instead was 4 years of industrial slaughter, financed by the most extraordinary borrowing in human history to that point. Britain sold war bonds to its citizens with patriotic fervor. The famous war loan campaigns exhorted every Briton to invest their savings in the nation's survival. France borrowed from domestic creditors and from Britain. Germany financed its war almost entirely through domestic borrowing, printing money and selling bonds in the expectation of extracting reparations from a defeated enemy. All of them borrowed from the United States, which entered the war in 1917 with vast financial resources and a creditor's interest in Allied victory. By the armistice of November 1918, the European economies were financially devastated. Britain had borrowed more in 4 years than in all its previous history combined. France was in worse shape. Germany was both defeated and bankrupt, its currency already weakening under the strain of war finance. And the peace settlement reached at Versailles in 1919 made everything worse by piling the question of reparations on top of the existing debt structure. Germany was assigned a massive reparations bill, ultimately fixed at 132 billion gold marks, to be paid to the victorious Allied powers. The Allies, in turn, owed war debts to each other and to the United States that they hoped reparations would help them repay. The result was a circular, unstable structure in which American banks lent money to Germany. Germany paid reparations to France and Britain, and France and Britain used the reparations to make payments on their war debts to the United States. When American lending to Germany slowed in the late 1920s, the entire structure began to crack. Germany's economy weakened. Reparations payments faltered. The Allies could not meet their debt obligations to Washington, and when the American stock market collapsed in October 1929, the cascade of debt failures that followed turned a serious crisis into a catastrophe. The Great Depression was, at its heart, a debt crisis. The moment when the accumulated obligations of the 1920s could no longer be sustained. The 1920s had been a decade of extraordinary credit expansion in the United States. Consumers borrowed to buy the new consumer goods, automobiles, refrigerators, radios, that American factories were producing in abundance. investors borrowed to buy stocks on margin, meaning they put up only a fraction of the purchase price and borrowed the rest, betting that rising share prices would produce gains sufficient to repay the loan with profit left over. Banks borrowed from each other, from the Federal Reserve, and from foreign creditors. Corporations borrowed to fund expansion. Farmers borrowed to buy equipment and land. The entire American economy was, by 1929, extraordinarily leveraged, built on layers of borrowed money, each layer resting on the one below. When stock prices began to fall in October 1929, the margin calls came first, brokers demanding that investors whose borrowed stocks had fallen in value either deposit more money or sell. The forced selling pushed prices lower, which triggered more margin calls, which forced more selling. Banks that had lent to stock speculators found their collateral shrinking. Some failed. When banks failed, the depositors who had kept their savings there lost everything, which reduced their spending, which hurt businesses, which reduced employment, which reduced spending further. The debt deflation that Irving Fisher had theorized was now visible to everyone, playing out in foreclosed farms and shuttered factories and bread lines stretching around city blocks. Between 1929 and 1933, roughly a third of American banks failed. Farm prices fell by half. Unemployment reached 25%. The government's response was initially to try to balance the budget, to maintain confidence in the dollar's gold backing by cutting spending even as the economy collapsed. This made things worse. It was only gradually, as Franklin Roosevelt's New Deal programs experimented with deficit spending and financial regulation, separating commercial banking from investment banking, creating deposit insurance, regulating securities markets, that the floor was found. The Depression's deepest lesson was one that took decades to fully absorb. That debt, when it collapses, can drag everything else down with it, and that government has a role in preventing that collapse from becoming total. The Bretton Woods Agreements of 1944 rebuilt the international financial system on a foundation designed to prevent the debt crises of the interwar years from recurring. In July 1944, with the war still ongoing, delegates from 44 Allied nations gathered at the Mount Washington Hotel in Bretton Woods, New Hampshire, to negotiate the financial architecture of the post-war world. The dominant figures were John Maynard Keynes, representing Britain, and Harry Dexter White, representing the United States. They disagreed about much. Keynes wanted a more symmetric system that would discipline creditor nations as well as debtors. White insisted on American primacy, but they shared a diagnosis. The instability of the 1920s and 1930s had been caused partly by unmanaged international debt flows, competitive currency devaluations, and the absence of institutions capable of providing stability when individual countries got into difficulty. The system they created, known as Bretton Woods, fixed exchange rates against the dollar, and the dollar against gold at $35 an ounce. International Monetary Fund was established to provide short-term credit to countries experiencing balance of payments difficulties, allowing them to smooth out temporary deficits without resorting to the currency manipulation and import barriers that had strangled trade in the 1930s. The World Bank was created to provide long-term development lending. The United States, as the world's dominant creditor, would anchor the system by guaranteeing the dollar's convertibility. For the 25 years after the war, the Bretton Woods system largely worked. International trade expanded. The great European and Japanese economies recovered and grew. The threat of the debt deflation that had devastated the 1930s receded behind a wall of institutional guardrails, but the system also contained the seeds of its own ending. It required the United States to run deficits to supply the world with dollars, and those deficits, accumulating over decades of Cold War spending and Great Society programs, gradually eroded the gold reserves that backed the dollar. In August 1971, Richard Nixon closed the gold window, ending the dollar's convertibility to gold, and the Bretton Woods system ended, replaced by floating exchange rates and a new era of financial experimentation. Consumer debt in post-war America grew from a modest convenience into a defining feature of economic and social life. Before the Second World War, most Americans regarded debt with a mixture of practicality and unease. Borrowing to buy a home or a farm was acceptable. It was an investment in the future, a way of converting current income into lasting assets. But borrowing to purchase consumer goods was still tinged with the stigma of improvidence. The Depression had reinforced this. People who had survived on credit in the 1920s and seen that credit evaporate in the 1930s retained a cautious relationship with borrowing that their children would eventually abandon. The change came gradually, accelerated by the GI Bill, the post-war housing boom, and the emergence of installment credit for automobiles and appliances. By the mid-1950s, the idea of borrowing to acquire consumer goods had become normalized, a mechanism for aligning consumption with aspiration, for having now what income would eventually provide. The suburban house, the new car in the driveway, the modern kitchen with its electric appliances. These were purchased overwhelmingly on credit, and the credit industry grew to meet the demand, developing new scoring systems and institutional arrangements to process the enormous volume of consumer lending that post-war prosperity required. The credit card, which emerged in its modern form in the late 1950s, was the pivot on which consumer debt turned from a structured arrangement into an open-ended way of life. Diners Club had introduced a charge card in 1950, requiring full payment at month's end. Bank of America's Bank AmeriCard introduced extraordinarily profitable for banks. It was also, for many cardholders, the beginning of a debt relationship that was difficult to exit. The credit card made debt invisible, instant, and easy. A frictionless mechanism for advancing spending against uncertain future income. The credit card transformed not just how Americans spent, but how they thought about money, obligation, and the relationship between present desire and future consequence. When D. Hawk, the executive who built Visa into a global network in the 1970s, described his creation, he called it a universal monetary system. He was not wrong. By the 1980s, the credit card network had become a piece of infrastructure as fundamental as the electricity grid. A system through which value moved invisibly and instantly, connecting buyers and sellers across every economic transaction that could be reduced to a swipe and a signature. The physical card in the wallet had become a portal to a line of credit that renewed itself each month, that could be used anywhere in the world, that required only a minimum payment to remain open and available. For middle-class Americans, credit cards were genuinely useful, a convenience that smoothed the bumps in monthly cash flow, that provided security when unexpected expenses arrived, that made travel and commerce easier. For lower-income Americans, they were often something more complicated. The interest rates on revolving balances, sometimes 20% or higher, climbing further in the deregulatory climate of the 1980s, after a Supreme Court ruling allowed banks to charge the rates permitted in their home states, regardless of where the customer lived, could turn a manageable balance into an obligation that grew faster than it could be repaid. By the end of the 20th century, American household debt had reached levels that would have astonished the Depression-era generation. Credit card debt, auto loans, student loans, and above all mortgage debt had become the normal condition of middle-class life. The economy had come to depend on this borrowing to sustain consumption, an arrangement that worked smoothly when incomes were rising and asset values were climbing, and that revealed its fragility when either condition reversed. The Third World Debt Crisis of the 1980s demonstrated how sovereign debt could hold entire nations in a kind of permanent dependency. In the 1970s, the major international banks, flush with petrodollars deposited by oil-exporting nations after the 1973 OPEC price shock, went looking for borrowers. They found them in the developing world. Latin American governments in particular borrowed heavily in dollars at interest rates that seemed manageable in the high inflation environment of the time. The loans funded infrastructure, import substitution, industrialization, and in some cases, simply the consumption demands of populations whose governments found it easier to borrow than to tax or reform. By 1982, Mexico had accumulated foreign debts that it could no longer service, and its announcement that it could not make the scheduled payment triggered a crisis that spread across Latin America and parts of Africa Asia, the International Monetary Fund, and the major creditor banks negotiated a series of emergency arrangements. The price of those arrangements was austerity, structural adjustment programs that required debtor countries to cut government spending, open their markets to foreign competition, privatize state enterprises, and maintain exchange rate policies favorable to debt repayment, regardless of the domestic economic consequences. The theory was that these reforms would restore fiscal balance and create the conditions for sustainable growth. In practice, many countries experienced years of falling living standards, rising unemployment, and social disruption as governments slashed programs, and the benefits of structural adjustment flowed primarily to creditors and foreign investors rather than to ordinary people. The decade became known in Latin America as the Lost Decade, a period in which economic development stalled or reversed, poverty rose, and the hopes of the 1960s and 1970s gave way to a grim reckoning with the consequences of borrowed money. The debt crisis was not simply an economic event. It was a transfer of power from debtor governments, which found their policy choices constrained by the terms of their obligations, to creditor institutions, which could effectively dictate economic policy, to nations formally sovereign but financially dependent. The economist Ravi Batra and others pointed out that this was a new form of an ancient dynamic. The creditor's leverage over the debtor, operating not between individuals, but between nations. The junk bond revolution of the 1980s showed how debt could be weaponized to transform the corporate landscape. Michael Milken, working at the investment bank Drexel Burnham Lambert, identified a fundamental inefficiency in the credit markets of the late 1970s. The large, established corporations that dominated American industry could borrow cheaply from banks and issue bonds at low interest rates because rating agencies judged them creditworthy. Smaller, newer, or financially strained companies were locked out of the bond market, forced to rely on expensive bank loans or equity financing. Milken began to quantify what the credit rating agencies had not adequately assessed, that the high-yield bonds issued by these below-investment-grade borrowers, junk bonds, actually offered investors adequate compensation for their risk, that the default rates were lower than commonly assumed, that an efficient market should be channeling capital to these borrowers at rates that reflected the real risk rather than institutional bias. The junk bond market that Milken built over the following decade channeled hundreds of billions of dollars into companies that traditional finance had overlooked. It funded cable television companies, airlines, telecommunications firms, and retailers that expanded rapidly with access to capital that would otherwise have been unavailable. It also became the primary instrument of the leveraged buyout. The corporate takeover financed not with the acquirer's own capital, but with debt borrowed against the target company's assets and cash flows. Raiders like Carl Icahn and T. Boone Pickens used junk bond financing to take over or threaten major corporations corporations, extracting value by selling assets, cutting costs, and redirecting cash flows toward debt service. The consequences were mixed in ways that remain disputed. The leveraged buyout wave did, in many cases, force efficiencies in bloated corporations. It also, in many cases, loaded companies with debt that made them fragile, unable to survive downturns that a less leveraged company would have weathered. When the junk bond market collapsed in 1989, partly as a result of regulatory scrutiny, and the savings and loan crisis that Drexel's activities had helped create, dozens of companies that had been taken private in leveraged buyouts found themselves unable to service their debt and entered bankruptcy. The workers who had lost their jobs in the cost-cutting that followed the initial takeovers found no compensation in the eventual bankruptcy filings. The savings and loan crisis was a lesson in how deregulation and deposit insurance can combine to create catastrophic levels of debt. The savings and loan institutions, the thrifts that served as the primary mortgage lenders for American families, had operated under a tightly regulated framework since the Depression. They took short-term deposits, paid regulated interest rates, and lent those deposits out as long-term fixed-rate mortgages. The system worked well in a stable interest rate environment. It worked disastrously when interest rates spiked in the late 1970s and early 1980s. The thrifts were paying high rates on deposits while earning low rates on their old mortgages, a mismatch that was mathematically guaranteed to generate losses. Congress and regulators, rather than managing the thrift's orderly contraction, responded by deregulating them, allowing them to offer market interest rates on deposits and to invest in a wider range of assets. The thrifts, now competing aggressively for deposits by offering high interest rates and deploying those funds into riskier commercial real estate, junk bonds, and speculative loans, became engines of very poor decision-making. Crucially, because deposits were federally insured, depositors had no incentive to monitor the risks their institutions were taking. The thrift's owners and managers bore the upside of risky bets. The federal insurance fund, ultimately the taxpayer, bore the downside. The bill for this moral hazard arrived in the late 1980s and early 1990s as the commercial real estate bubble burst and thousands of thrifts failed. The Resolution Trust Corporation, created to manage the cleanup, ultimately disposed of several $100 billion worth of bad assets. The final cost to taxpayers was somewhere between $125 and $150 billion. At the time, the most expensive financial rescue in American history. It would not hold that record for long. The 1990s brought new debt crises to Asia, demonstrating that the patterns of borrowing, overexpansion, and collapse were not confined to the developing world or to particular political systems. Through the late 1980s and early 1990s, the economies of South industries and financial speculation, often assuming that their currency's link to the dollar was a permanent feature of the landscape. When that assumption broke, when a speculative attack on the Thai baht in July 1997 forced the Thai central bank to abandon its dollar peg, the entire structure of assumptions that had sustained Asian borrowing collapsed with startling speed. Thai, Indonesian, and Korean currencies fell sharply in value, making it dramatically more expensive to repay dollar-denominated debts from local currency revenues. Companies that had been profitable suddenly found themselves technically insolvent. Banks that had extended credit to those companies found their loan portfolios impaired. Foreign lenders, nervous, demanded repayment of short-term loans, which forced borrowers to sell assets at distressed prices, which depressed markets further, which made lenders more nervous. The Asian financial crisis was a classic debt-driven panic, compressing into months what the Great Depression had spread across years. The IMF's interventions, conditional loans in exchange for fiscal austerity and structural reform, were controversial. Critics argued that the IMF's conditions were inappropriate for economies that were not profligate, but had been caught by the sudden reversal of capital flows that global financial integration made possible. The crisis left lasting political scars. In Indonesia, it contributed to the fall of the Suharto government. In South Korea, it accelerated the restructuring of the chaebol, the family-controlled conglomerates that had driven the country's export success. And it generated a determination among Asian central banks to accumulate foreign currency reserves sufficient to never again be dependent on IMF rescue. A policy that would itself have significant global economic consequences in the years ahead. The rise of student loan debt in the United States created a new form of debt that would shape the life choices of a generation. Higher education in the United States had always carried a cost, but through the mid-20th century, that cost was manageable. Public universities, heavily subsidized by state governments, charged tuition that a working student could realistically earn over a summer. The GI Bill had made college free for returning veterans and demonstrated in the process that a well-educated workforce was a national investment rather than a private luxury. But through the 1970s and 1980s, as state governments faced fiscal pressures and tax revolts, they reduced their subsidies to public universities. Universities responded by raising tuition. Federal student loan programs, created to make college accessible, expanded to fill the gap. And the gap kept widening. By the early 2000s, a generation of college students was graduating with debt that had been unimaginable to their parents. The average debt load rose steadily. Graduate and professional degrees, law, medicine, business carried debts that could run to six figures. The student loan market had also developed a private sector component. Banks and financial institutions offering loans alongside the federal program, often at higher rates, sometimes with terms that were not clearly disclosed. And crucially, student loan debt was treated differently from almost every other form of debt under American law. It could not be discharged in bankruptcy, a protection carved out in 1976 and progressively strengthened, leaving borrowers who could not repay bound to their obligations with no exit. The human consequences were significant and diffuse. Young people with large student debt delayed marriage and children, put off home purchases, and made career choices driven by debt service rather than preference or calling. The teacher with a passion for education, who calculated that a teacher's salary could never service a law school debt load, and chose corporate practice instead. The doctor who chose a lucrative specialty over primary care to manage medical school loans. The entrepreneur who declined to start a company because the risk was impossible to absorb when the monthly loan payment had to be made. These individual calculations, multiplied across millions of households, represented a form of resource misallocation that cost the economy something difficult to measure but real. The 2008 financial crisis was the largest debt implosion in the history of capitalism, and its origins lay in the American mortgage market. Through the early 2000s, American home prices rose steadily and then rapidly, generating a self-reinforcing belief that they would continue rising indefinitely. This belief animated a transformation of the mortgage market that had been building for decades, but accelerated dramatically in the years after 2000. Mortgages, once local instruments held by the banks that originated them, were now packaged into securities, mortgage-backed securities, collateralized debt obligations, and sold to investors around the world. The securitization pipeline required a constant supply of new mortgages, which drove lenders to relax their standards, extending credit to borrowers who had previously been excluded from the mortgage market and had sometimes been excluded for good reason. The loans that flooded into the lowest tiers of the market were called subprime. Mortgages extended to borrowers with weak credit histories, limited documentation of income, or financial positions that made the repayment of even a traditional fixed-rate mortgage challenging. Many of these mortgages carried adjustable rates that started low and reset sharply upward after 2 or 3 years. A structure that worked only if the borrower could refinance before the reset, which worked only if home prices continued rising, which could not go on forever. The securitization machine had created a system in which the people who made the loans bore none of the risk of default. The investors who bore the risk often did not understand what they had purchased, and the rating agencies that certified the safety of the securities were paid by the institutions whose products they rated. When house prices stopped rising in 2006 and began to fall in 2007, the consequences moved through the financial system with extraordinary speed. Subprime borrowers who could not refinance defaulted. The securities built from their mortgages fell in value. Banks securities, often with borrowed money, found themselves facing losses that exceeded their capital. In September 2008, the failure of Lehman Brothers, one of the largest investment banks in the world, triggered a global financial panic of an intensity not seen since 1931. Credit markets froze. Banks refused to lend to each other. The shadow banking system that had financed much of the housing boom simply stopped functioning. The government response to the 2008 crisis was unprecedented in scale, and the debates it generated about who bore the costs of the bailout continue to this day. Treasury Secretary Henry Paulson and Federal Reserve Chairman Ben Bernanke, facing the possibility of a global financial collapse, made a series of extraordinary interventions. The Troubled Asset Relief Program, TARP, authorized the Treasury to purchase up to $700 billion in troubled assets from financial institutions. Though in practice, the money was used primarily to inject capital directly into major banks. The Federal Reserve, using powers that had never been deployed on this scale, extended emergency credit to financial institutions far beyond the traditional banking system, purchasing mortgage-backed securities, commercial paper, and eventually long-term treasury bonds in quantities that expanded its balance sheet from under $1 trillion to more than $4 trillion. The banks were saved. The financial system stabilized. But the recovery that followed was extraordinarily uneven. The financial sector returned to profitability within 2 years. Home prices eventually recovered, and in many markets surpassed their pre-crisis peaks. Corporate profits reached record levels. But for the 10 million American households that lost their homes to foreclosure, there was no bailout. For the workers who lost jobs as the crisis spread into the broader economy and spent years out of work, the recovery arrived slowly, if at all. The inequality that had been building through the preceding decades deepened. Those who owned financial assets benefited from the Federal Reserve's interventions. Those whose primary asset was their home, and whose home was underwater, did not. The political consequences were profound and lasting. On the left, the experience generated the Occupy Wall Street movement, a diffuse protest against the concentration of financial power, and the sense that the rules of the economy operated differently for the connected than for everyone else. On the right, it generated the Tea Party, a movement animated by a different anger at the government spending and debt that the crisis had produced, and at what felt like an establishment preference for sophisticated financial actors over ordinary taxpayers. Both movements were, at their core, responses to the same underlying phenomenon, a debt crisis in which the costs had been distributed very differently from the benefits. The European sovereign debt crisis that followed showed that the contagion from 2008 had crossed the Atlantic and was reshaping the political landscape of the Eurozone. Greece, Ireland, Portugal, Spain, and Cyprus, the countries that came came to be known by the ungainly acronym PIIGS, had each borrowed heavily in the years after the euro's introduction. The euro had been a boon to their borrowing capacity. Membership in the currency union was interpreted by markets as an implicit guarantee from the richer northern European economies, and interest rates in the periphery fell dramatically after 1999. Greece, in particular, used this cheap credit to finance government spending that its tax revenues could not sustain, while also understating its deficits in official reports. Ireland and Spain had borrowed not through government spending, but through private sector, real estate booms financed by international credit. When the global financial crisis hit and markets began to scrutinize what they had been financing, the periphery's situation became untenable. Greek government bonds fell sharply. Ireland's banking system, which had backstopped an enormous property bubble, required a government bailout that pushed the Irish state's debt to GDP ratio to levels that required its own external rescue. The European Central Bank, the IMF, and the European Commission, the Troika, provided emergency loans in exchange for severe austerity programs that required cuts to public services, pensions, and wages. In Greece, the consequences were severe and visible. GDP fell by 25% between 2008 and 2013, a contraction comparable in depth to the Great Depression. Unemployment reached 27%. Hospitals ran short of medicines. Pensioners who had worked all their lives found their retirement income cut repeatedly by agreements negotiated between their government and foreign creditors. The Greek case became a referendum on a fundamental question that the history of debt had posed from the beginning. When a debt cannot be repaid, who should bear the loss? The debtor, who borrowed unwisely or dishonestly, or simply unluckily, or the creditor, who lent to a borrower who was not creditworthy. The idea of the debt jubilee, a periodic cancellation of debts, is older than finance itself, and it keeps returning to economic and political discourse. Whenever debt accumulation reaches levels that seem unsustainable, the concept comes from the Hebrew Bible in the book of Leviticus. Every 50 years, the Jubilee year debts were to be canceled, enslaved Israelites freed, and land that had been sold returned to its original family. The Jubilee was, in this sacred text, not an act of charity, but a structural necessity, a periodic reset of the accumulations that time and inequality inevitably produced. Without such a reset, the logic of compound interest and economic advantage would eventually concentrate all wealth in a few hands, destroying the social fabric that the law existed to protect. Ancient Mesopotamia, as we noted at the beginning of our journey, had its own version of this. The Anjurar, royal debt cancellation issued at the accession of new kings, or in times of particular distress. The fact that both the Hebrew and the Sumerian traditions developed this concept independently in roughly the same historical period and the same geographic region suggests that it reflected a real and recurring social need. Debt accumulates. When it accumulates beyond the capacity of debtors to repay, when the mathematics of compound interest outrun the growth of productive capacity, something has to give. Managed forgiveness, the ancient administrators understood, was preferable to the disorder that followed when it was not managed. The anthropologist David Graeber, in his 2011 book Debt, the first 5,000 years, argued that this history had been largely suppressed, that the narrative of financial history emphasized the sanctity of debt contracts while obscuring the long record of debt forgiveness as a legitimate and often necessary tool of social order. Graeber pointed out that the modern moral weight attached to debt repayment, the sense that failing to repay a debt is a profound moral failing regardless of the circumstances of the borrower, is itself a historical construction, one that serves the interests of creditors over debtors, and that is not supported by the full sweep of historical practice. His argument was controversial. It was also widely read, appearing at a moment when millions of people around the world were living with debts they had accumulated in circumstances they had not fully chosen and could not fully control. Student debt forgiveness became one of the most contentious political questions in the United States in the 2020s, replaying ancient arguments about debt in a modern key. The student loan portfolio of the federal government grew to more than $1.7 trillion by the early 2020s, making it the second largest consumer debt category in the United States after mortgages. The demographic profile of that debt was politically charged. It was owed disproportionately by younger Americans, by Black and Latino borrowers who had relied more heavily on loans to finance education, by graduate degree holders in fields like social work and education, where salaries were modest relative to the debt they carried. The pandemic had paused student loan payments through a series of administrative actions that stretched for years, creating a constituency of 45 million borrowers accustomed to not making payments and politically attentive to the question of whether those payments would resume. The Biden administration's attempts to forgive significant portions of federal student loan debt were challenged in court on the grounds that the executive branch lacked the authority to cancel debts without explicit congressional authorization. A separation of powers argument that the Supreme Court ultimately upheld. The political debate around this question was a remarkably clear replay of debates that had recurred through the entire history of debt. Creditor-oriented arguments emphasizing moral obligation, the unfairness of forgiving debts incurred voluntarily, and the perverse incentives that forgiveness would create. Debtor-oriented arguments emphasizing that the terms of many student loans were not freely chosen in any meaningful sense by 18-year-olds without financial sophistication. economy had changed in ways that made the promised returns on education inaccessible to many borrowers, and that forgiveness was a legitimate exercise of the same government authority that had generated the debt in the first place. There was no resolution in sight. The question of who should bear the losses when debt cannot be repaid, and who is morally responsible for the circumstances that produced the default, is as old as debt itself, and its answer has never been settled definitively. It is negotiated anew in each generation, in each financial crisis, by the balance of political forces that debt and its consequences generate. Corporate debt in the early 21st century reached levels that raised questions about whether the economy had become structurally dependent on cheap borrowing in ways that made it fragile. The Federal Reserve's response to the 2008 crisis, keeping interest rates near zero for years, and then keeping them low throughout the recovery, created an environment in which debt was cheap on a historical scale. Companies that might, in an earlier era, have relied on retained earnings or equity financing to fund expansion, found that borrowing was so inexpensive that it made financial sense to issue bonds even when they didn't urgently need the cash. Many large companies used cheap debt to buy back their own shares, returning capital to shareholders in a tax-efficient form, boosting earnings per share, and often triggering the stock-based compensation that executives were paid. The buyback boom of the 2010s was, at its core, a debt-fueled transfer of corporate assets from the company's long-term balance sheet to its shareholders' pockets. The consequence was that many large American corporations entered the 2020s with debt loads that would have seemed imprudent by earlier standards, not because they were reckless, but because the incentive structure of historically low interest rates had made leverage rational. When the pandemic struck in early 2020 and revenues collapsed for airlines, hotel chains, retailers, and energy companies, many found themselves unable to service debt they had taken on in the good years. The Federal Reserve's rapid response, purchasing corporate bonds, including investment-grade bonds, for the first time in its history, provided a floor under the corporate debt market and prevented a cascade of corporate failures that would have amplified the pandemic's economic damage. But the episode raised uncomfortable questions. A financial system in which the central bank was compelled to support not just the banking system, but the corporate bond market, was a system in which risk had been privatized and backstopped, had been socialized in ways that were not fully transparent. The companies that had used cheap debt to enrich shareholders in the good years were now relying on public support to survive the bad years. The pattern was familiar from the history of debt. The gains flow upward, and the losses, when they arrive, spread outward. Predatory lending, the practice of extending credit on terms designed to trap rather than to serve the borrower, is as old as money lending itself, and it has never been more widespread than in the contemporary United United States, the payday loan industry, which grew rapidly in the 1990s and 2000s as banking deregulation opened space for new financial products, offers short-term cash loans, typically a few $100s, to be repaid on the borrower's next payday, usually within 2 weeks. The fees charged on these loans, expressed as annual percentage rates, typically range from 300 to 500% rates that would have been recognizable to a medieval usurer, and that the medieval church would have condemned without hesitation. The industry justifies these rates by pointing to the small absolute dollar amounts involved, the administrative costs of short-term lending, and the high default rates among their clientele. Critics point out that the typical payday borrower does not repay the loan in 2 weeks, but rolls it over repeatedly, paying fees each time until what began as a $200 loan has generated many times its original value in fees, without the principal being meaningfully reduced. The borrowers who use payday lenders are overwhelmingly people who lack access to conventional banking credit, people who are too poor, too credit impaired, or too financially irregular in their income to qualify for a bank loan or a credit card with a reasonable rate. This is the ancient pattern. The people who most need credit and who are most desperate pay the highest rates and receive the least favorable terms. The wealthy borrow cheaply from institutions competing for their business. The poor borrow at punishing rates from lenders who know that their customers have no alternatives. Consumer financial protection has expanded and contracted repeatedly in American regulatory history, with each expansion generating industry opposition and eventual rollback. The Consumer Financial Protection Bureau, created by the Dodd-Frank Act of 20 prices up to 10 times their original level. Members of Parliament, the king's mistresses, prominent members of society, all bought shares, often on credit, borrowing against the rising value of their shares to buy more. When the bubble inevitably burst in August 1720, the collapse was devastating. Thousands of investors who had borrowed to participate found themselves with worthless shares and unreduced debts. Isaac Newton, who had already sold his shares at a profit, and then, watching others get richer, bought back in near the top, reportedly lost £20,000, a vast fortune, and remarked that he could calculate the motions of heavenly bodies, but not the madness of people. The aftermath produced a lasting caution about joint stock companies and share speculation in Britain that persisted for over a century, slowing the development of the corporate form that would eventually be essential to industrial capitalism. It also produced the first serious parliamentary investigation into financial fraud, and one of the first political scandals driven by conflicts of interest between legislators and the financial interests they were supposed to regulate. The structure of the problem: promoters creating an asset whose price depended on the confidence of buyers, buyers borrowing to participate, and thereby amplifying both the boom and the bust. reproduced with variations in every subsequent financial mania. The American Civil War forced both the Union and the Confederacy to innovate in the financing of conflict, with consequences that reshaped American finance for generations. Abraham Lincoln's administration faced a fiscal challenge of unprecedented scale. The war's cost was enormous, far beyond anything the federal government's limited pre-war revenue base could support, and the traditional means of raising funds were insufficient. J. Cook, a Philadelphia banker whom Secretary of the Treasury Salmon Chase appointed as the government's primary bond salesman, devised a solution that was as much a marketing operation as a financial one. He sold Union war bonds, the 520 bonds that paid 6% interest and were redeemable between 5 and 20 years, directly to ordinary Americans through a network of subagents spread across the northern states, using newspaper advertising and patriotic messaging to make bond purchasing a civic act. For the first time in American history, ordinary households in significant numbers became holders of government debt. The Confederacy, lacking the financial institutions, the banking system, and the foreign credit that the Union possessed, resorted primarily to printing money, issuing Confederate paper currency in quantities that quickly generated the inflation that direct tax could have prevented. Confederate inflation accelerated as the war went against the South, reaching levels that destroyed the purchasing power of Confederate savings and contributed to the hardship that undermined civilian support for the war effort. The fiscal contrast between the two sides was stark. The Union's ability to borrow at manageable interest rates from a broad base of loyal creditors was a significant military advantage. The Confederacy's inability to establish credible public credit contributed directly to its defeat. After the war, the question of how to handle the debt that both sides had accumulated was itself politically charged. The 14th Amendment to the Constitution explicitly repudiated Confederate debt, forbidding any effort to pay the bonds issued to finance the rebellion, while guaranteeing the validity of Union debt. The message was clear and deliberate. The creditors who had bet on the Union were protected. Those who had bet on the Confederacy bore the full loss. Debt, here as elsewhere, carried a political verdict. The founding of the Federal Reserve in 1913 represented a public sector response to a century of financial panics, driven by the instability of private credit. The United States in the 19th and early 20th centuries had no central bank. The Second Bank of the United States had been killed by Andrew Jackson in 1836, partly on the grounds that it represented a concentration of financial power incompatible with democratic governance. What it had instead was a national banking system of remarkable dynamism and remarkable fragility. Private banks issued their own currency backed by government bonds. Credit expanded aggressively in boom times and contracted sharply in busts. Panic's sudden, self self-reinforcing contractions of credit that froze commerce and produced cascading bank failures, struck in 1873, 1893, and most dramatically in 1907, when only the personal intervention of J.P. Morgan, who convened the leading bankers in his library and refused to let them leave until they had agreed on a rescue package, prevented a complete financial collapse. The panic of 1907 demonstrated that leaving the stability of the credit system to the judgment of one elderly private banker, however formidable his judgment, was an inadequate arrangement for a modern industrial economy. The Aldrich-Vreeland Act of 1908 created a commission to study the monetary systems of Europe and recommend reforms. Its work eventually produced the Federal Reserve Act of 1913, which established a system of 12 regional Federal Reserve banks under the oversight of a board of governors. The Fed's initial mandate was modest: to provide an elastic currency that could expand in times of stress and contract as conditions normalized, and to serve as a lender of last resort to solvent banks facing temporary liquidity crises. What the architects of the Federal Reserve did not fully anticipate was how expansively that mandate would eventually be interpreted. By the 21st century, the Federal Reserve was not only managing the money supply and supervising banks, but conducting vast open market operations in government and mortgage-backed securities, setting the interest rate that governed the cost of credit throughout the economy, and serving as the de facto stabilizer of last resort for the entire financial system during crises. The institution that was created to tame the wilder impulses of private credit had become, in a sense, the backstop of all borrowing, a guarantor whose presence allowed more debt to accumulate than might otherwise have been prudent, because everyone knew, in the end, that the Fed would try to prevent a total collapse. Microfinance promised to bring the benefits of formal credit to the world's poorest borrowers, and its story is a lesson in how good intentions interact with the mechanics of debt. The economist Muhammad Yunus founded Grameen Bank in Bangladesh in 1983 after noticing that small amounts of capital, the equivalent of a few dollars, could make the difference between poverty and viability for rural craftspeople who could not access formal bank credit. Grameen's model was built on group lending, small clusters of borrowers, usually women, who guaranteed each other's loans and whose social bonds created repayment pressure that formal collateral could not. The model spread globally, spawning thousands of microfinance institutions in Africa, Latin America, South Asia, and Southeast Asia, and Yunus was awarded the Nobel Peace Prize in 2006 for what the Nobel Committee called his efforts to create economic and social development from below. The evidence on microfinance's impact has been, to put it gently, more complicated than its early champions hoped. Rigorous studies conducted in the 2010s found that access to microfinance loans did not, substantially lift household income or generate the entrepreneurial dynamism that the theory predicted. Many borrowers used microfinance loans not to invest in productive activities, but to smooth consumption, to manage the gaps between irregular income and regular expenses. Some used them to repay existing debts, and in regions where competition among microfinance lenders heated up, the industry reproduced some of the pathologies of predatory lending. Multiple loans from multiple lenders, aggressive collection practices, interest rates that compounded on short loan terms into annualized rates far higher than conventional banks would charge. Microfinance story is not a story of failure. Access to credit genuinely helps some people in some circumstances, and the evidence does support that. But it is a reminder that credit is not magic, that debt can help only when the underlying economic conditions make repayment feasible, and that good intentions and innovative structures cannot override the fundamental mathematics of borrowing. The interest must eventually be repaid from income that the borrower must actually earn. Cryptocurrency and the decentralized finance movement of the 2010s and 2020s attempted to build a new architecture of debt outside the existing financial system, with results that were simultaneously innovative and chaotic. Bitcoin, introduced in 2009 in the immediate aftermath of the financial crisis, was conceived partly as a response to the concentrated financial power that the crisis had made visible. Its creator, the pseudonymous Satoshi Nakamoto, described it as a system for electronic cash transactions that required no trust in any central authority. No bank, no government, no institution that could fail or be corrupted or be laid out at public expense. The blockchain, the distributed ledger that recorded every transaction, was designed to be trustless, meaning that its validity depended not on the honesty of any party, but on the cryptographic difficulty of altering historical records. Decentralized finance, DeFi, extended this vision to lending and borrowing. By the early 2020s, there were platforms allowing users to deposit cryptocurrency as collateral and borrow other cryptocurrency against it, with interest rates set algorithmically by supply and demand, and the entire transaction recorded on a blockchain with no human intermediary. Billions of dollars flowed through these systems during the cryptocurrency bull market of 2020 and 2021. The protocols were, in their technical architecture, genuinely novel. No bank, no credit officer, no central authority had ever governed lending in quite this way. The collapses that followed were equally novel in their speed and scale, but familiar in their structure. The Terra Luna system, which had offered depositors 18% annual yields through mechanisms that depended on continued confidence to function, collapsed in May 2022 within days, destroying roughly $40 billion of value. The crypto lender Celsius network, which had borrowed short and lent long in classic banking style, insurance or regulatory oversight, froze withdrawals, and went bankrupt in 2022. FTX, the exchange whose founder had been celebrated as a visionary, collapsed in November 2022 amid allegations that customer deposits had been used to cover losses at a sister trading firm. The innovations of DeFi had produced an architecture that was new. The patterns of debt, trust, leverage, and eventual reckoning were ancient. The psychological dimensions of debt, the shame, the anxiety, the way that being in debt reshapes a person's relationship to their own future, have been less studied than the economic dimensions, but may be equally important. There is a reason that virtually every major religion has something to say about debt. It is a moral relationship as much as a financial one, an obligation that extends through time, and that carries with it a set of expectations about character, reliability, and honor. In many cultures, failing to repay a debt is not simply a legal problem, but a social one, a marker that others will use to assess your trustworthiness, your commitment to your obligations, your reliability as a neighbor, a partner, a community member. The fear of this judgment is often a more powerful enforcement mechanism than legal sanction. Research in behavioral economics and psychology has documented the cognitive effects of carrying debt. People in debt spend significant mental energy managing their financial situation, tracking balances, calculating payments, anticipating collection calls, monitoring their credit score. This cognitive load, sometimes called the bandwidth tax, reduces the mental resources available for other decisions. People in financial stress, studies have found, perform worse on cognitive tests that have nothing to do with money. They make worse decisions in unrelated domains. The debt is not just a financial problem. It occupies space in the mind that could otherwise be devoted to work, to parenting, to creativity, to all the activities that make a life. The subjective experience of debt also shapes social behavior in ways that are difficult to measure. People in debt report higher rates of anxiety and depression. They are more likely to report conflicts with partners and family members. They describe a kind of temporal shrinkage, the sense that the future has been pre-committed, that choices have been foreclosed by obligations already made. This feeling, so personal and so private, is nonetheless the aggregated experience of hundreds of millions of people around the world at any given moment. A vast collective weight whose economic and social consequences are real, but often invisible in the aggregate statistics of financial analysis. The environmental implications of debt have become one of the defining challenges of the 21st century, as the debts embedded in the natural world begin to come due. Economists have long spoken of natural capital, the productive capacity of ecosystems, the atmosphere's ability to absorb emissions, the ocean's capacity to sustain fisheries, as a form of wealth that any sense that the drawing down of these assets created an obligation that would eventually need to be honored. The climate crisis is, in this sense, a debt crisis. For 2 centuries, industrial economies have been borrowing from the atmosphere, emitting carbon dioxide and other greenhouse gases in quantities that the natural carbon cycle cannot absorb, without recording the obligation or making any provision for its repayment. The consequences of this unrecorded debt are now becoming visible. Rising temperatures, extreme weather, sea level rise, ecosystem disruption, the cost of addressing them, transitioning energy systems, adapting infrastructure, managing the displacement of communities whose homes are becoming uninhabitable is staggering. And as with all debts that have been deferred too long, the question of who owes what to whom has become intensely political, with historical emitters pointing to current obligations and developing nations pointing to historical responsibility and demanding that the cost not fall primarily on those who contributed least. The concept of intergenerational debt, the obligations that present generations are accumulating and passing to those who will follow, extends beyond climate to many dimensions of public finance. The pension promises made to aging populations in developed countries represent obligations to future taxpayers who had no voice in the decisions that created them. The infrastructure that has been allowed to deteriorate will eventually require replacement at the expense of those who will inherit it. The ecological systems that are being degraded will either be restored at cost or will impose their costs through reduced productivity and increased vulnerability. In each case, the mechanism is the same. The present is borrowing from the future, and the future will have to pay. Debt, at the deepest level, is a relationship between the future and the present. A claim that what will exist can be traded against what exists now. Every debt contract contains a theory of the future, an assumption that the debtor will be in a position to repay, that the economy will function well enough to generate the income or revenue required, that the legal and social institutions that enforce obligations will remain intact. When those assumptions are correct, debt performs an extraordinary service. It allows the future to fund the present, making possible investments in education, infrastructure, science, and enterprise that would be impossible if every project had to wait for sufficient savings to accumulate. The hospital built on borrowed money that saves lives for decades. The university funded by endowment that began as donated capital. The startup company financed by venture investment that invents something the world did not know it needed. These are the gifts that debt makes possible. The assumptions are wrong when the future does not deliver what was promised, when the economy falters, or the institution fails, or the borrower's circumstances change in ways that no contract could have anticipated. Debt becomes a weight. It presses on the present with the accumulated promises of a past that cannot be revised. The farmer who borrowed when crop prices were high and finds them low. The graduate